Hey guys, what is going on? Jay here. This is smarthelping.com. We're in a brand new Excel workbook today. It's Friday. I'm still trying to figure out a new financial model template to build for something. I don't know what yet. And in the meantime, I wanted to do a video about something I worked on with a client the other day. And that was for, well, let's real estate and then specifically strip malls acquisition. And the main problem we were discussing was they wanted to show that some of the you've got lease up costs, you've also got tenant improvements, and you've got leasing commissions. So these three things will have costs. Let's say we've got out in time here a couple 24 months. These costs likely happen after you've started collecting rents from some of the tenants. Now, when you're trying to go to investors and say you need a certain amount of money, you need to figure out, you've got all your initial period zero costs. So period zero is, we've got all the different purchase price less any loan proceeds you get, closing costs, maybe acquisition fees, um, renovation budget, all kinds of different one-time costs that definitely need to be happening in period zero, and so you have an amount of cash you need right up front for those things. You have these other things though, where the investor you don't want to go to investors in month 8 and say, well, this tenant ended up, not we didn't get at least for longer, so now we don't have enough cash to cover some of these expenses that we had modeled, so we need more cash. So to avoid that, a lot of what this client specifically wanted was it to be dynamic to say, okay, let's just say you have some random expenses here for the first few months for lease up. And these could be a combination of all kinds of different expenses. And let's say you've got tenant improvements happening here over time, maybe some here. You'll have some schedule that's going to populate those numbers, and then leasing commissions. Let's say you might have some up front, maybe some down the road here, what have you. And now we need to dynamically, and the key is to make it dynamic so the user doesn't have to keep changing the numbers manually here. So we want to say, well, we have our initial costs. So let's say we also have the purchase price, closing costs, debt, just so you can kind of see a general picture. So we'll have this will be, say, minus some amount of money, debt proceeds. Okay, so we know we definitely need this much to raise for cash. And now what I did in the model is you're going to have two cash flows. Cash flow cumulative, and this would be for the project. So this actually says when things are going to happen. And let's say we also have NOI up here. And then maybe you've got debt service down here as well. And I'm just putting in random numbers. These are not real numbers. Okay. And we want to know, well, here's what our cash flow looks like for the project. And we'll also add in this, minus this, minus this, minus this, minus this. Okay. So we go out 22 months. There's our cash flows. That's when things actually, based on these costs happening, this is how much we expect to have. Now let's raise this up a little bit because I want to show you, let's assume this is negative. These are a bit higher, maybe. Okay. So the project is seeing, well, we've got negative cash flows for the first 18 months, then we start to stabilize, and we can cover these expenses with our net operating income. So the trick is, and we have our cumulative cash flow. The trick is we want to say, well, how much of these expenses right here do we need upfront? And initially, the client was going to do all of them, 100% of these costs up front. So you're just simply modeling, making sure your NOI is greater than your debt service. If it is, if you can guarantee that, then you can tell the investor the only cash you're going to need is just for the upfront operations. And again, that could vary if the NOI changes. You really want to make sure that it's got to be pretty extreme for you to go negative cash flow in these first few months for capital calls, because you do not want to do a capital call if you can help it. Alrighty. Let me zoom out a little bit. And no, I do offer financial modeling consulting, and I sell hundreds of templates. You can go to smarthelping.com to find those. I've been doing that for a living for a decade now. It's really fun. Okay, so we have cash flow here. Now we need to say, well, what we want to define some months here that are dynamic. So we want to say, maybe for 6 months you're going to pay for these 5, and through the first 12 for this one. Okay, so there's our references that we can change whenever we want. Now we need to do a calculation here to check if, and it'll be like a double, so we'll have a set here for reference. If this number is less than or equal to this number, then 0, otherwise 1. And then we can lock this, lock that on that side. Okay, so do we not lock it? No. A is locked this way, and D is locked this way. Okay, so there we have it. Lease up costs, we know, okay, through the first 6 months, if it's a 0, we need to be summing up these right up front. So right here, I'm going to say, okay, sum ifs. And you might have somewhere else that you are populating these data points, and if so, you can target that, but I'm just going to do it right here. So summing up that, if my month number here is less than or equal to this, and we could just lock the top. Okay, now look, I've now increased my capital requirement from, so it was, before I did that, 440,000. Now it's 482, because I've added $42,000 in cash I need up front. Now you don't want to double count, so you got this cash coming out up front. So when it actually happened, you don't want to also subtract it here. So now you can see, look at this cash flow of the project. We're now double counting. So in period 0, you don't, in the cash flow for the project, you don't count any of these lease up costs, tenant improvements, leasing commissions. So 12, 13, 14, we don't want in here, otherwise we'll be double counting. We do want them here, as well, as long as along with everything else. And this is for situations, it could be for different expenses as well, but it's just for expenses that happen in the future that you want to account for up front in your investor calculations. So the project itself, you're not going to pay all these up front. They're going to come out over time, and you actually want to see that in display. Okay, this is when we think these costs are going to happen. We're accounting for 6 months of this up front, 5 months of this, and 12 months of this up front. So now we go, so we have this little calculation helper here, and we could say simply Watch this. So here's where it all comes together. If this equals 0, then 0. Otherwise, the only other thing it could be is 1. We want to pull this expense, because if it's a 1, we're going to use the expense and it's going to hit cash flow. If it's a 0, it's actually been accounted for up front. So now this helper, we can now dynamically reference for our investors what does their cash flow look like, and that's going to be, the profit in both cash flow scenarios. And let's say there's an exit here. Let me put an exit in just to give you just a general idea of this and how it affects returns. Let's say an exit of, let's say 900,000. So we want to add that in. Okay. So we have cash flows, investor. So what's the investor going to have? Well, they're going to have the NOI, obviously. You're going to be paying debt service. We're not going to touch this. We've got the purchase price, closing costs, debt proceeds. And note, this is not just investors. This would be, I guess, equity. So if it's a joint venture, it'd be the GP and the LP's equity requirements that might be split a certain way, what have you. But okay, so we have all these. We are not counting anything in 12, 13, or 14. We're actually going to go down here. Subtract out here, here, and here. Now what you put down here is actually your upfront. So remember, these are dynamically calculated. So we know there's your 482. Okay. So 482 up front, and then as we go along, this cash flow is actually higher than the project because we're covering that initial upfront cost right here. So more cash required up front, but now we get more cash flow out of this NOI because we don't have to pay these 3 costs for a few months because we already kind of accounted for it. Okay, so let's drag this over. Oh, and we got to add the exit value, obviously. Drag this over all the way to the end. All right, now you should see that these numbers end up being the same, or else we did something wrong. Yep, 368. So that's our profit. But the cash flows over time were different, and it's important for us. We want to see this stream with when these expenses happen, and these expenses could be coming from all kinds of different logic. But right now I've just hard-coded it in. And so here's what that looks like, but then here's what the investor funds look like. So they're going to put up 482, or the total equity for the project. Put up 482, and then here's what's going to be available. Now you still have some negatives here, which is, maybe you want to say, well, we're going to pay this through the 17 months, and this through 12, and this through 12. Okay, now you do have some negatives here, but you've produced more cash flows than negatives, so your negative cash requirement here, let's see, the min, which is going to be important to know, is still 562. It's still this number. If the min is some number out here, then you've got more burn than you can handle from what you've raised, and you're going to need more money, or you should have raised more up front. Again, the total net profit is the same in both scenarios, both cash flow streams, but the timing of it and how much you take is what matters. So we want to say, well, investors, this is how much we're going to need if we want to stay solvent for the period, for the whole period. Now, if you're distributing this money out right away, then yeah, even any negative cash flow months are going to be problematic. But if you're, let's say this is going into an operating account and it's just there, if you need it in the future, you can use it, and then there's distributions made systematically as the operating account builds up or whatever, that's fine. That gets more into the actual calculations. We're just focused more on modeling. Okay, so, and then we have IRR. So I want to show you this. So this is a monthly schedule, so we can convert that. So we'll go IRR of this. And then we want to say, well, that's actually the monthly. Let's convert it to an annual rate. So 1 plus the rate raised to the 12 minus 1. So our annual IRR is 32. And if we did that for this stream, it's 36. So really the actual returns based on your planning is your IRR is a little bit lower. Doing the project's IRR, you're saying, well, some of these negative cash flows we're going to collect in the future, and so that means you've got less up front, and therefore the IRR is a time-weighted metric, and it's going to say since some of those negative cash flows are delayed, the internal rate of return is actually higher. But this is the more accurate one, the 32% in this case. Now I've done this with a couple models where you have the project cash flows here, and then you have a separate investor where you can manually type in how much you're getting from investors, how much you're distributing from them, and then an operating account calculation, which then combines both of those to figure out what's your actual operating account balance, and you just keep that above zero. And the returns are calculated based on what cash you put in versus what you spit out and returned. So this is kind of a form of that, but it's a little bit different because we're doing this dynamic calculation here where we want to say, you know, what if we don't want to collect any upfront? Well, now look, the IRRs are exactly the same. These cash flows are exactly the same because we're saying, well, when these happen, it's going to hit, and so that's when we're going to collect the cash. Or you could say you're going to collect 100% of it up. You just put in a number here that's greater than your total monthly periods, and that just says, okay, all this 152 is the total of all of these. We're going to collect all that up front. So now our cash requirement is 592, and then now our total cash available to distribute would be just your NOI less any debt service, and then the exit, and that's what we measure against that initial investment. Okay, so hopefully this was helpful to anyone doing financial modeling for acquisitions of strip malls or any other business where you have this dynamic. And then what's nice is if you had a sources and uses here, we could do that really quick. So if you had a source here, you got debt and equity. Our debt is this. Our equity is, in this case, this number, the negative mid-negative cash flow, which should be period 0. Uses, you've got, now this is where it gets a little tricky, but the way we set up is very useful. So you've got the purchase price. You're going to use that money for closing costs. And then here's the tricky one. We're going to use just the amount we collect up front of these three. Okay, so this was purchase price, closing costs. What was the 26? Okay, oh, and then these three. Lease up, and then you can put like a dynamic calculation saying, this is first space and this space and a month. So it dynamically says the amount of months that these are for. So when we sum these, now these should equal. And they do. That's good. And so that's how it would kind of sit on the sources and uses here. Okay. If you want more financial models or want to hire me, go over to smarthelping.com. Financial models tab at the top here. I've got hundreds of financial models for all kinds of different businesses and industries. They have 3-statement logic for income statement, balance sheet, cash flow statement connected to assumptions. They have monthly pro formas, cash flow, IRR. Most of them are for joint venture ready. I've got a bunch for SaaS, recurring revenue businesses, real estate models, joint venture funds, a lot of GPLP frameworks here, general business valuation, accounting templates, and all sorts of things I've built in Excel that I've productized here over the last decade that you can check out. Um, you can also buy by bundle. Um, if you want to go to template discounts, pre-configured bundles, you can see all the different bundles here, or you can just buy everything on the site for $4.99 as well, or you can buy templates individually. If you want to hire me, go to the Hire tab. My rate's $275 an hour, and I am generally pretty quick. Turnaround times within a day or two. And I like to get on the call. The more clear your assumptions are, and if you know what you need built, the quicker the job will take. In general, things on average, I've got the stats here for this is pulling from my actual live data. On average, for 2025, the average active client has spent 5.8 hours, spending $1,588, and that's just the average. Some might be more, some might be less. It depends on the job. But usually, one-time clients are in and out in a couple days. I do have some long-term clients where I'll do work here and there every few months or every month for a few hours, and that's completely fine. I have plenty of capacity, we'll say, um, right now. So let me know if you need something done, and we'll talk through it. Alrighty, like and subscribe, and I'll see you on the next one.